Hi, I'm Susan Ballard, owner of BookkeepingForSuccess.com, and I'm here today to talk to you about building a strong financial house that will ensure you have the information you need to manage the financial health of your company. If you're like most business owners, you set up your business based on something you're passionate about. Your vision includes a great product or service superior to your competitors. However, there is another very important side of the business that can drain you of your energy. Few business owners have a passion rooted in the bookkeeping side of the business, and for most, this is a drooling task. The problem here is that one of your most important tools, financial analysis, is based on your business records. Accurate financial records will help you answer some very important questions. Are you making money or losing it? How much? Is your business on sound financial ground, or are troubles lurking ahead? A sound bookkeeping system is the foundation on which all of this valuable financial information can be built. As a small business owner, you may rely on an outside accountant to do your taxes and prepare your financial statements. I often hear, "My accountant does all of that work for me at the end of the year." Having your accountant do your bookkeeping chores is not only the costly route, but also doesn't allow you to effectively run your business throughout the year. Today, we're going to briefly discuss the steps to building a strong financial house. The first step is setting up the books. As a business owner, you need to take an active part in setting up your books. It's a good idea to sit down with your accountant in the beginning and discuss your business. What are your goals? How will you set up your books to best serve your business? Will you operate on a cash or accrual basis? What will your chart of accounts look like? What software will best serve your business? Cash or accrual, what's the difference? The cash method is the more commonly used method of accounting in small business because it's easy. Under the cash method, income is not counted until cash or a check is actually received, and expenses are not counted until they are actually paid. There are no accounts payable or accounts receivable. Cash accounting ensures that taxes are not paid on monies not received. For companies that do a great deal of cash business and don't maintain large inventories, cash accounting is a convenient and reliable way of tracking expenses and profits without necessitating a great deal of bookkeeping. The downside of cash accounting is that you lose the ability to track the details, such as the actual dates of sales and purchases, and you have no detail regarding outstanding bills or money owed to you. Under the accrual method, transactions are counted when the order is made, the item is delivered, or the services occur, regardless of when the money for them is actually received or paid. In other words, income is counted when the sale occurs, and expenses are counted when you receive the goods or services. You don't have to wait until you see the money or actually pay money out of your checking account to record a transaction. This approach keeps income and expenses linked to the period in which they happened, no matter when the cash comes in or goes out. The advantage of accrual accounting is that it provides a better picture of profitability because income and its corresponding expenses appear in the same period. It allows companies to understand spending habits of consumers and also plan better for peak months of operation. Let's move on to chart of accounts. Why is my chart of accounts important? First, let's define chart of accounts. Your chart of accounts is the foundation upon which your financial record-keeping system is built, a posting map for recording financial transactions. It's a listing of the names of the accounts that your company has identified and made available for recording. Most software packages come with one or more standard generic charts of accounts. Can you use one of these? Yes. However, these charts of accounts are designed for the masses and therefore basic. Even businesses that are the same type may have unique or different requirements. what you will strive for is a chart of accounts as simple as possible, yet tailored to provide the information and reports for managing and controlling your business. What you can do is start with one of these generic chart of accounts and add to or delete accounts as necessary. Now, let's move on to software. What software will best serve my business? You'll want to talk to other people in your industry. Find out what they're using. Read vendor literature and Google third-party reviews online. Some software companies will offer you a trial version so you can actually try it out. There are two types of software, online and desktop. If you're going to use an outside bookkeeper or accountant, most use a particular software and will want you to use that same software. Frequently, that's QuickBooks. Although desktop versions generally offer more enhanced options and can offer industry-specific versions with customizations geared towards specific industries, online software is web-based and you can use it anywhere you have an internet connection. This is ideal for the business owner who is always on the go, or if you're outsourcing your bookkeeping, it allows both you and your bookkeeper to access your software from any computer. You also need to understand your hardware situation. You'll need to take a good look at your disk space. As your accounting data grows, the more room it will need. If you're using a desktop version, you'll need to have backup procedures in place to protect your data. This isn't an issue with online software as it automatically backs up on secure servers. The second step in setting up our bookkeeping system is entering the data. This is pretty self-explanatory. This is the entering of your receipts, bills, money received, checks written, etc. Two very important things about data entry: setting up a time frame for entering data and knowing your chart of accounts. You need to have a time frame for entering data. Don't wait too long to process your transactions. Receipts get misplaced or lost, and the details of the transaction may be forgotten. Know your chart of accounts. Have an idea of where you would like certain items to appear, and then be consistent with your data entry. This is an important task whether you outsource your bookkeeping duties or do it yourself. For example, is the paper you purchase to make brochures an advertising expense or an office expense? This decision isn't critical to the IRS, but consistency in this area can be important to you so that when you look at that account total on the expense report, you know what that total represents. If you don't know the proper way to enter a transaction, ask. For example, you receive a customer deposit for services not yet rendered. Is this income? In many cases, if not most, this isn't income. It's actually a loan from the customer until services are rendered. Therefore, it needs to be entered accordingly. Consistency of your data entry is directly linked to the accuracy and consistency of your financial reports. Of course, this is one of the benefits of using an outside bookkeeper to do this work for you. Accuracy and consistency. If you don't have these two things, then your time spent entering this data is in vain and your reports are not of much use to you or your accountant. The last step in our setup process is the analysis of what these numbers mean. This involves reviewing the reports and deciphering what the numbers are trying to tell you about your business. To run a business effectively, you must be able to read, understand, and analyze accounting reports and financial statements, as financial information is the heart of business management. This financial information is your business's health report. The most important reports are the balance sheet, the profit and loss statement, and the cash flow statement. A balance sheet is a snapshot of accounts on a given date. This report shows how much your company owns, how much it owes, And the difference between these two is the equity in the company at a given point in time. This report measures your financial strength. The key to a good-looking balance sheet is not having too much debt. Balance sheets should be produced at regular intervals and should show the true worth of the company. The profit and loss report, also known as the income statement, is more like a video than a snapshot. It answers the question, how did we do? It covers a period of time, usually a month, a quarter, or a full year. It summarizes all of the resources that have come into the company, or your revenue, all of the resources that have left the company, and the resulting net income or loss. Monitoring your income allows you to measure the effectiveness of sales methods to ensure your profitability goals. The third report is the statement of cash flows. This report answers the question, where was the cash used? It helps your company figure out whether you generate enough cash to keep the doors open. Cash flow is nothing more than the real money that flows in and out of your company as it pertains to operations, financing, and investing. Profit growth doesn't necessarily mean more cash on hand. Profit is the amount of money you expect to make over a given period of time, while cash is what you must have on hand to keep your business running. Over time, a company's profits are of little value if they're not accompanied by a positive net cash flow. You can't spend profit, you can only spend cash. Therefore, understanding your cash flow is a very important task in managing your business. To summarize, the 3 steps to building a strong financial house are 1. Setting up the books, 2. Entering the data, and 3. Analyzing what the numbers mean. Taking these steps will strengthen your decision making and improve your bottom line because you have taken the time to learn what the numbers mean. You know your sales activity and your gross profit. You know the major category of expenses that drive your business, and you review them regularly to ensure you are still on budget. Knowing these very important numbers is critical to the success of your business. I hope I have in some way enhanced your understanding of the importance of building a strong financial foundation for your business. If you're still thinking, thanks for the info, but numbers are just not my thing, I invite you to give me a call. Let's sit down and discuss your business and what it might take to get you set up with a record-keeping system that will allow you to track your progress and know what's happening with your business 365 days a year. For contact information, visit my website, www.bookkeepingforsuccess.com, or find me on Facebook.